The scene establishes financial entrapment through a bustling neon city at night. Workers swiping credit cards visually link them to the pervasive nature of debt. Glowing chains connecting individuals to bank skyscrapers symbolize financial burden. The visual metaphor of chains represents the pervasive and binding nature of financial debt. Credit card transactions are visually represented as direct conduits to financial institutions. The neon city serves as a visual representation of the allure and potential pitfalls of modern finance. Banks create money when they issue loans. The loan issuance process effectively creates new digital currency. Newly created money is immediately balanced by an equivalent debt. This process increases the overall money supply in the economy. The creation of debt is an inherent part of the money creation process. The debt creation mechanism is a fundamental aspect of modern banking. Debt can be visualized as a leash, restricting movement and autonomy. The length of the debt leash symbolizes the degree of financial constraint. Control of the debt leash implies significant power over the debtor. Understanding who controls the debt leash is crucial for assessing power dynamics. Debt can be a tool for influence, shaping decisions and limiting options. Analyzing the structure of debt reveals underlying power relationships. Homeownership is often perceived as complete control, but mortgages introduce a lender's interest. Mortgages grant banks a legal claim on the property until the loan is fully repaid. The bank's financial stake in the property creates a shared ownership dynamic. Until the mortgage is satisfied, the bank retains ultimate control over the property. Inflation erodes purchasing power, leading to a decline in the real value of money. Rising prices of everyday goods reflect the impact of inflation on consumer spending. Inflation reduces the amount of goods and services that can be purchased with a fixed amount of money. The silent thief effect of inflation diminishes the real value of savings and investments over time. Wage increases may not offset inflation, resulting in a decrease in real income. Inflation can lead to economic instability and uncertainty in financial planning. Inflation erodes the purchasing power of savings over time. Assets like stocks and real estate tend to appreciate in value during inflationary periods. Inflation effectively transfers wealth from savers to asset owners. Owning assets can serve as a hedge against the negative effects of inflation. The debt cycle involves governments borrowing through bonds. Banks create money through loans, perpetuating the debt cycle. Citizens pay interest, contributing to the continuous debt cycle. The gears represent the continuous and interconnected nature of the debt cycle. The debt cycle is powered by constant activity. This system creates a self-perpetuating cycle of borrowing and repayment. The system's operation relies on the consent of its participants rather than physical coercion. Workers willingly participate in the debt cycle, perpetuating the system's function. Awareness and informed choice are crucial for individuals within the system. The debt cycle is a self-reinforcing mechanism that perpetuates systemic reliance. Systemic consent underscores the importance of individual agency and collective responsibility. The allure of a new car can trigger emotional spending, leading to debt accumulation. Initial excitement during a purchase can mask the long-term financial obligations. Debt can be visualized as invisible constraints limiting future financial freedom. Financial paperwork represents a binding agreement to repay borrowed funds. The emotional trap of debt involves trading future financial security for immediate gratification. Understanding the emotional drivers behind debt is crucial for responsible financial management. Acquiring financial knowledge is represented as studying a glowing blueprint of assets. The chains symbolize the grip of debt, visually representing financial constraints. Breaking free from debt is depicted as the chains gradually cracking and disintegrating. Financial knowledge serves as the key to unlocking freedom from financial burdens. The process of acquiring financial literacy is a journey towards financial liberation. The blueprint of assets embodies the strategic planning required for financial independence. Good debt involves acquiring assets that generate income or appreciate in value. A rental property mortgage is an example of good debt, as it can generate rental income. Bad debt typically involves liabilities that drain money without providing substantial returns. A car loan is often considered bad debt because the car depreciates in value and incurs ongoing expenses. The key difference lies in whether the debt increases your net worth or decreases it over time. Cash loses purchasing power over time due to inflation. Assets like stocks tend to appreciate in value, outpacing inflation. Real estate values typically increase, providing a hedge against inflation. Businesses can grow in value, offering a potential inflation-resistant investment. A salary paycheck provides a one-time payment that is typically consumed by monthly expenses. Assets generating cash flow, such as rental properties or investments, provide ongoing income streams. Active income, like a salary, requires continuous work to maintain the income stream. Passive income from assets continues to generate revenue without requiring constant active work. Financial education empowers individuals to identify investment opportunities and avoid potential pitfalls. Knowledge acquisition in finance leads to exponential growth, surpassing the accumulation of mere monetary wealth. A strong foundation in financial principles enables individuals to achieve financial independence and security. Continuous learning and adaptation are crucial for navigating the complexities of the financial landscape. True wealth, according to the Stoic trader, is defined by control over one's time. Time freedom is visualized as the ultimate goal of financial independence. Financial independence enables individuals to allocate their time according to personal values and priorities. The Stoic trader emphasizes the importance of aligning financial strategies with the pursuit of time autonomy. The debt game is structured to perpetuate continuous labor rather than facilitate financial liberation. The system traps individuals in a cycle of debt, compelling them to remain in perpetual employment. The urban environment visually reinforces the sense of entrapment experienced by the working population. Fundamental change is necessary to break free from the constraints imposed by the debt-driven system. Understanding the underlying mechanics of debt allows for informed decision-making. Awareness of the code empowers individuals to choose alternative financial strategies. Breaking free from the debt cycle involves adopting new financial behaviors. Choosing a different path leads to financial independence and stability. Financial literacy is essential for navigating and altering the debt landscape. Empowerment comes from understanding and actively reshaping one's financial reality. Buying assets is a fundamental strategy for building wealth. Assets increase in value over time, contributing to overall net worth. Assets generate income, providing a continuous stream of revenue. Acquiring assets helps individuals escape the cycle of debt. Multiple income streams generate continuous cash flow, reducing dependence on a single paycheck. Diverse income sources can include investments, side businesses, and passive income opportunities. Building cash flow provides financial security and greater economic independence. Continuous cash flow allows for reinvestment and further expansion of income-generating assets. The scene depicts an individual breaking free from glowing chains, representing the release from debt. The act of walking away symbolizes the attainment of financial freedom and independence. Glowing chains represent the burden and restriction associated with financial debt. The city skyline in the background signifies the world of financial obligations and responsibilities. The phrase, "escape the debt game," visually reinforces the core message. The message aims to encourage viewers to seek financial freedom. The visual representation symbolizes breaking free from financial constraints. The scene provides a visual metaphor for overcoming debt and achieving financial independence. The system often presents money as a symbol of freedom. However, this portrayal can be deceptive, masking underlying constraints. The pursuit of money may inadvertently lead to new forms of dependency. True freedom extends beyond mere financial wealth. Glowing chains visually represent the worker's connection to financial institutions. These chains symbolize a feeling of entrapment and dependence. The visual metaphor of chains intensifies the sense of being bound to financial systems. The glowing chains serve as a visual reinforcement of economic constraints. The chains highlight the unseen forces linking individuals to larger financial structures. Key financial lessons are often omitted from standard school curricula. This omission symbolizes a deliberate withholding of crucial knowledge. The absence of financial education can lead to economic disadvantages. Financial literacy empowers individuals to make informed decisions about their economic well-being. Digital banking systems facilitate the rapid creation of money through electronic transactions. The ease of digital money creation contrasts with the physical effort typically associated with earning income. Modern banking leverages digital infrastructure to efficiently manage and expand monetary supply. Digital transactions enable instantaneous money transfers, bypassing traditional physical constraints. The value of digitally created money is maintained through trust in the financial system and regulatory oversight. Digital money creation involves complex algorithms and secure protocols to ensure financial stability. Digital dollars initiate their flow from the bank towards the worker. The initial transfer of digital funds creates an allure of accessible money. The flow of digital dollars represents a transaction between financial entities. The ease of digital transactions highlights the convenience of modern financial systems. Digital dollars symbolize the transition to a cashless economic system. Taking a loan immediately results in the consequence of incurring debt. The burden of debt is symbolized by heavy chains clamping down. These chains represent the restrictive nature and long-term commitment associated with loans. The weight of these chains increases over time, reflecting the accruing interest and repayment obligations. Debt itself is not inherently negative. The potential for control exerted through debt is the key concern. Unmanaged debt can restrict financial freedom and decision-making. Debt's negative impact arises from its potential to limit choices. Responsible debt management allows for leveraging opportunities. Understanding debt's dynamics is crucial for financial well-being. Debt involves power dynamics that raise questions about beneficiaries. Financial obligations can create an imbalance of power between debtors and creditors. The structure of debt can be designed to disproportionately benefit certain parties. Understanding the flow of capital reveals who ultimately controls the financial leash. Debt instruments can be tools for maintaining economic control and influence. Analyzing debt structures is crucial to identifying potential exploitation and inequality. Failure to meet mortgage payments results in the bank's repossession of the property. The mortgage agreement grants the lender a legal claim against the property as collateral. Consistent payment defaults lead to foreclosure proceedings initiated by the lending institution. The bank assumes ownership of the property following successful completion of the foreclosure process. Eviction notices are issued to occupants after the bank reclaims the property. Ultimately, the bank's financial interest supersedes the homeowner's claim in cases of mortgage default. Car ownership, like other financed assets, is conditional upon continued payments. Failure to maintain payments results in repossession, terminating the ownership agreement. Conditional ownership highlights the importance of financial responsibility and contractual obligations. The car serves as a visual representation of assets acquired through financing. Continued payments ensure the transition from conditional to full ownership. Ownership is a process, not just a transaction, dependent on fulfilling financial commitments. Student loan debt represents a significant long-term financial obligation for many graduates. The burden of student loans can impact post-graduation financial decisions and opportunities. The cumulative effect of interest rates increases the total repayment amount of student loans. Various repayment plans and financial aid programs exist to alleviate the pressure of student loan debt. Financial literacy and strategic planning are crucial for managing student loan debt effectively. Debt creates the illusion of ownership, masking underlying financial obligations. Monthly payments represent the ongoing cost of maintaining this illusion of ownership. Individuals are bound by these recurring financial commitments, limiting true financial freedom. The perceived benefits of ownership are often outweighed by the long-term burden of debt. Inflation acts as an invisible tax, eroding purchasing power without direct legislative action. This erosion of purchasing power occurs without explicit consent, unlike traditional taxes. The impact of inflation is felt through a reduction in the quantity of goods and services that can be acquired with the same amount of money. Unlike explicit taxes, inflation's effects are often subtle and not immediately apparent to the consumer. The invisible tax of inflation reduces the real value of savings and investments over time. Inflation's impact is pervasive, affecting various sectors of the economy and individual financial well-being. Inflation's impact is not uniform. It disproportionately affects individuals with lower incomes. Those with fewer assets are more vulnerable to rising prices due to a larger portion of their income being allocated to essential goods. Wealthy individuals often possess assets that appreciate in value during inflationary periods, offsetting the increased cost of goods. This disparity exacerbates existing wealth inequalities, widening the gap between the rich and the poor. Individuals metaphorically serve as fuel within the debt cycle. The collective effort of individuals sustains the debt-driven system. The debt cycle is perpetuated by the continuous input of individual contributions. Visualizing individual roles highlights their significance in maintaining the economic framework. The system's functionality depends on the ongoing participation and contributions of individuals. The system's stability relies on the consent of its participants, rather than on overt force. Awareness of the system's mechanics is crucial for individuals to make informed choices. Choice is a fundamental element in maintaining the system's perceived legitimacy and functionality. Without informed consent and genuine choice, the system risks instability and potential collapse. Fear of missing out, FOMO, is often triggered by exposure to curated content on social media. Social media feeds often showcase idealized lifestyles, creating a perception of widespread happiness and success. This perceived universal happiness can drive viewers to make impulsive purchases in an attempt to replicate the showcased lifestyles. The desire to keep up with social trends can lead to debt-fueled spending habits. Luxury items and experiences are often presented as essential for social acceptance and validation. The constant stream of aspirational content on social media can perpetuate a cycle of FOMO and impulsive spending. Some consumers purchase items beyond their financial means to project a desired social status. This behavior can lead to unnecessary debt accumulation and financial instability. The pursuit of status symbols often outweighs practical financial considerations. Impression management through conspicuous consumption can create a cycle of financial strain. Financial well-being is compromised when purchases are driven by external validation rather than actual need. Banks often present themselves as institutions that help individuals achieve their dreams. The dreams sold by banks often involve financial products such as loans and mortgages. These financial products come with terms and conditions, effectively charging rent for the use of borrowed capital. The concept of rent is visualized as ongoing payments required to maintain access to the promised dream. This system can be perceived as manipulative, as the initial promise of a dream is contingent on sustained financial obligation. The financial institution benefits from this arrangement through interest and fees, regardless of whether the dream is ultimately realized by the individual. A blueprint filled with diverse assets symbolizes the strategic path towards financial freedom. Strategic investments are the foundational elements for building long-term financial security. Diversification across multiple asset classes mitigates risk and enhances potential returns. The blueprint visualizes a clear, actionable plan for achieving financial independence through informed investment decisions. Financial freedom is the ultimate goal, achievable through disciplined planning and strategic asset allocation. Debt can be categorized into two main types: good debt and bad debt. Good debt is typically associated with assets that appreciate in value or generate income. Bad debt is usually linked to liabilities that depreciate quickly and do not generate income. Strategic borrowing involves leveraging good debt to acquire assets and generate wealth. The poor often acquire liabilities, which consume their limited financial resources. Liabilities, unlike assets, reduce net worth and increase financial burdens. Common liabilities include consumer debt, high-interest loans, and depreciating assets. The accumulation of liabilities perpetuates a cycle of financial instability and poverty. Understanding the difference between assets and liabilities is crucial for financial well-being. Strategic financial planning can help individuals shift from acquiring liabilities to accumulating assets. Wealthy individuals strategically use debt to acquire income-generating assets. Leveraging debt allows the wealthy to control larger asset pools than their initial capital would permit. Income generated from these assets is then used to repay the debt, creating a cycle of wealth accumulation. This strategy accelerates wealth accumulation compared to solely relying on personal savings or income. Effective debt management is crucial to ensure the sustainability of this wealth accumulation strategy. Inflation erodes the real value of cash over time, diminishing its purchasing power. The same amount of cash buys fewer goods and services as prices increase due to inflation. Investing in inflation-proof assets can help preserve and grow wealth despite inflationary pressures. Inflation-indexed bonds and real estate are examples of assets that tend to retain value during inflationary periods. Assets, including stocks, real estate, and businesses, have the potential to grow over time. The growth of assets can outpace the effects of inflation, preserving and increasing purchasing power. Stocks represent ownership in companies and can increase in value as the company grows and becomes more profitable. Real estate appreciates in value due to factors such as location, demand, and improvements. Financial freedom is achieved through generating passive income streams. Passive income allows wealth to accumulate independently of direct labor or a fixed salary. Focusing solely on a higher salary may not lead to financial freedom without additional income streams. Financial freedom provides greater flexibility and control over one's time and resources. Building diverse passive income sources reduces financial risk and increases long-term stability. Passive income refers to earnings derived from assets that require minimal active involvement. Assets generating income while one sleeps exemplify the power of passive income streams. Diverse passive income sources can include investments, royalties, and automated businesses. Building passive income streams can lead to financial independence and long-term wealth accumulation. Knowledge compounds exponentially over time, similar to financial interest. Increased knowledge leads to enhanced financial understanding and decision-making. Financial freedom is a direct result of consistent knowledge acquisition and application. Investing in knowledge yields higher long-term returns compared to solely focusing on monetary investments. Understanding the debt game allows for the identification of financial traps. Recognizing debt traps is the first step toward building financial freedom. Financial literacy is crucial for spotting and avoiding debt traps. Proactivity in financial management is essential for long-term financial well-being. Building financial freedom involves actively managing and understanding debt. Financial literacy and proactive management empower individuals to achieve financial independence.